My name's Edward Burbage. I'm the founder and CEO of Burbage Capital, which is an East African advisory firm. And I'm delighted to have been asked to chair this very distinguished panel. Okay, we'll be discussing the financial services sector, looking particularly at the banking sector. This has been a very profitable sector and prolific for investment deals. Is this sustainable in your?
There is still great amount of work to be done. I mean, the level of financial exclusion in terms of number of people unbanked is still very high, whether you look at Kenya, Tanzania, or even further afield. Now, beyond that, yes, you're absolutely right. The comp sets, comparable transaction sets are very, very high, very well defined in places like Kenya. But in the further you go afield to Tanzania and Uganda, Rwanda, etc., Zambia, there really is still a great deal of work to be done.
In your view, is it easy to invest into the banking sector through a debt instrument?
I think it's much easier. Because the relationship is not so exclusive and it's not so long-term. So, a bank can come to us within a few weeks, money is in, and within 2-3 years, money is out. And I think for us, it's also easier because we can diversify. So, for example, we have 11 different banks and microfinance institutions across the 3 or the 4 East African countries, whereas typically do 2 or 3 investments in a region. So, investment-wise, it's very helpful.
Andy, just moving on to you now. What are some of the key challenges that you think need to be considered before investing?
A lot of these banks, especially in the encoded space, they're family founded, they're community based and owned, so they have a certain identity, and they grew because they basically serviced a certain kind of market segment. And the key thing is, as the investor, is not to act as a disruptor to that particular model and demonstrate how you can basically make that model more scalable and not necessarily criticize it because the risk that took the bank to be what it is not understood.
And just bring Gladys in here. From the advisory perspective, what do you think has been the impact on valuations from the attractiveness of the sector? And then perhaps you could also comment, there have been a lot of deals already in the banking sector and how you feel.
In terms of valuation, considered to be a very sexy industry. Every private equity house coming into this region for the first time, like the banking sector, because 1, it's regulated, 2, it's growing. I mean, it's the only sector that seems to make money when everybody else seems to be suffering. And a lot of people are not very happy with the morality around that. But what makes a successful bank? And I think that's what then drives the valuation. So when you look at the sector, there's been questions of, okay, is there going to be some form of consolidation? Now we're seeing it's moving towards more of collaborating across the financial sector. So it's not about consolidation, it's about, the banks getting bigger by being more innovative. So we're going to see more growth, more innovation, and the most innovative bank is actually the one that's going to survive.
So, Mr. Njoka, I'm going to bring you in here. Abraj has made 2 exits from the financial sector in the last 2 years. Are you trying to tell us something?
I think that's not an indicator of anything. I think we're always in the business of investing and exiting from transactions. Actually, we've been in financial services from way back. In the early 2000s, we were in CBA. Acacia Fund was a shareholder and exited. And you can see where CBA is now.
How do you all balance the engagements with the banks? How do you look at trainings, learnings, adoption of innovative technologies into the banks?
In terms of our approach to value addition, I mean, in financial institutions, especially the regulated ones, it's a fairly straightforward case of having quarterly board meetings, board committees, etc., and really facilitating the institution's development through that. Now, in the fintech space, because it is at a younger stage of development, you do have to be a lot more hands-on. In terms of creating synergies between them, it is literally as simple as saying, you guys want to go in that space, or you want to use that delivery channel and are thinking about this particular new product, or thinking about creating better linkages between credit risk and credit pricing. Here's a company that does that, and by the way, it happens to our portfolio investee. So.
My panelists, thanks very much indeed. Thanks to the audience.